So what we're looking at within real estate and REITs now globally is that we've come off of a year of pretty significant underperformance versus the broad equity markets for real estate and in a sector that was out of favor. And when you look at 2021, the landscape shifts a bit. So there are reflation opportunities within real estate that are doing very well in this rising rate environment. They're not only taking advantage of reflation, but they're taking advantage of the reopening. So you have sort of this double R effect within REITs, where you have reflation as well as reopening and a sector of, or a basket of property types that are really benefiting from that. The hotel REITs, the retail REITs recovered. Some of the office REITs showed strong recovery. And then even within what were formerly defensive property types, we saw strong recoveries in areas like healthcare, senior housing. The other area within REITs that is exciting for investors and a bit different than maybe private real estate markets is that you've got another basket of property types. And this basket isn't necessarily levered to reflation or the reopening, but this basket really has property types and companies that have secular demand growth and market share for their businesses. These are emerging real estate property types. The market share is growing, so they're not cyclical. So that's pretty exciting as well when you think about the space. So that would include data centers, cell towers, single-family rental homes. So all of that bodes well for REITs, and they're starting to catch up to make up ground for some of that relative underperformance versus the broader equity markets in 2020. So we think the space sets up favorably in spite of both, what would typically be pretty negative headlines, rising rates, as well as retail and office headwinds in the space.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.